Well, I guess I'll say welcome back to most of us. This is Dave Whitmore. Thanks for continuing on this little options boot camp journey with us, the options hike, if you will. So we're getting close to the midpoint, and at this point, we are going to bring in a new voice. I'm going to hand it over to Ken Keating from the OIC, the Options Industry Council, which specializes in options education. They're related in the industry to the exchanges and the Options Clearing Corporation. There's a long history there. Maybe Ken will regale us with a little bit of that. So he's going to be taking us through our topic here, covered calls. So first, let me speak to the disclosure slide here. I just want to make two things clear. We all know options aren't necessarily for everyone. They can be complex. I encourage you to read the booklet Characteristics and Risks of Standardized Options. You can see it referenced in the middle of the screen right there. You'll find a link to that on any options-related page in the E-Trade website, so you should check that out. It's a worthwhile read. And second, we're unaffiliated. OIC and E-Trade are not affiliated companies. We are independent, and so you are here to hear the work of Ken Keating in that regard. So we're going to do a little poll, as we have been doing all along the way. So I'm going to ask you to sort of give us a temperature check on how you think about this topic. So far, we've learned about the basics of buying an option and what a call option is, and then Sean went through several scenarios. We're now turning to the strategy called covered call writing. How confident are you about that at this point? Reflect on yourself. What do you think you know about it? How much maybe you've heard about it in the past, and give me a feedback there. And of course, the point of this is to simply get your temperature check going in and then coming out and see how you feel at that point. So with that, I am going to welcome Ken Keating from the Options Industry Council to carry us through on our topic here at the covered call. Ken, welcome.
Well, thank you, Dave. Happy to be here, and welcome everybody to today's E-Trade Boot Camp, and for joining us here today. So I do want to send a big shout out to E-Trade and to Dave and Sean and Rick and all the great people at E-Trade for all they do for the ever-growing community of options investors, for presenting this event and allowing me to participate on behalf of OIC. So I'm really excited to be here. So you can read my bio. So I'm a principal in investor education at OCC, as well as an Options Industry Council instructor. And I've been at OCC for roughly about 4 years, but before coming to OCC, I was a professional options trader for well over 25 years. So I was a floor market maker and a floor specialist on the floor of the Pacific Coast Stock Exchange in the early 90s. I then worked as a floor market maker and a floor specialist in Chicago on the CBOE. I've run risk management desks, off-floor prop books. I've traded for myself as a sole proprietor for many, many years, as well as working as a derivatives and equities analyst. So, I've certainly worn many hats within the industry, but the hat I currently wear is with OCC to help individual investors such as yourselves to better understand both the risks and the benefits of exchange-listed options. So we always have to mention our disclaimer, speaking of risks and benefits. So as Dave mentioned, anybody who's looking to trade options should thoroughly read and understand the characteristics and risks of standardized options. You can obtain a copy digitally by visiting us at optionseducation.org, or you can reach out to the kind people at E-Trade for a physical copy, or any exchange on which options are traded if you prefer a physical copy as well. In order to simplify the calculations used today, commissions, fees, margin interest, and taxes have not been included. And lastly, any strategies that we discuss here today are strictly for illustrative and educational purposes. All right, here are some of the trademarks and logos you will see throughout my presentation. This is strictly for all the lawyers at OCC. Okay, a little bit about OIC. Who exactly is the Options Industry Council? Well, the Options Industry Council, who I work for, we are effectively the education arm of OCC. So OCC, the Options Clearing Corporation, is the world's largest equity clearinghouse for exchange-listed options within the United States, as well as the Foundation for Secure Markets. So OIC started out as a cooperative in 1992 to better educate the public both on the risks and the benefits of exchange-listed options. And we do so primarily through our website, optionseducation.org. There you'll find free online courses, podcast videos, as well as additional webinars on just about any subject that you can imagine. And the pride and joy of OIC is our investor education desk, which can be reached at options@theocc.com Monday through Friday, 8 a.m. to 4 p.m. Central Standard Time, with any and all of your options-related questions. So this is a completely free service, and we are fully funded by OCC. So we're not looking to upsell you on subscriptions or tiers of service. We just want you to be better educated on the product, and hopefully you're making good trades and making a lot of money along the way. But also just keep in mind that we're not registered advisors, so we can't talk to you about setups, specific stocks, where you should be investing your money in the options market. But we can talk to you about general theory, strategy, or how corporate action may impact your options position. Okay, so with that out of the way, let's get started. So here's today's presentation outline. So today I'm going to be talking about the covered call. And the covered call is probably one of the more popular of all the option strategies. There's plenty of strategies out there, and the covered call is right up there with one of the more popularly traded strategies. So we'll be looking at the traditional covered call. Then we will be examining a variation of the covered call known as the poor man's covered call, where we'll use a leap or a long-term option as a stock substitute to somewhat simulate a covered call, and we'll be comparing those strategies side by side. So Q&A will be conducted along the way with my colleagues, Dave, Rick, and Sean, and time permitting, maybe we can entertain some live Q&A at the end of the presentation as well. All right, with that, let's get started. So covered calls. So covered calls, to kind of build on what Sean was talking about when he was talking about long options. So when we own options, we own rights. And we own, in the case of a call, we own the right to buy or sell 100 shares of stock on or before expiration. Well, the flip side of that equation is somebody who sells the call. And somebody who sells the call has the obligation to deliver, in the case of calls, stock at your strike price should you be assigned on that call. So the reason why people might do covered calls is to generate some income over the life of that call. Hopefully, in theory, you want that call to expire worthless, and anything that you sell that option for goes into your pocket. That's yours to keep. So investors will choose anywhere from weekly, monthly, even farther term options to sell against their long holdings to generate income. And every time we sell a covered call, we're essentially going to have a new break-even price on the value of our stock. We'll get into that in the following slides, but it's going to shift our break-even or our entry price on those shares. So the time frame and strike selection is always going to be dependent upon your own individual forecast and your risk tolerance. So there's no right or wrong answer in terms of which strike is perfect, which month is perfect. It's really going to vary from individual to individual. Now, assignment is always possible when we're trading American-style options. So American-style options, for the most part, are options that trade on single stocks and ETFs within the United States. So an American-style option doesn't mean it trades in America. It just means that it can be exercised at any time on or before expiration for whatever reason the long holder wishes to. Now, we'll get into why somebody might exercise early later on, but just know that anybody who exercises early is foregoing any time premium or extrinsic value left in their options. So there has to be an economic incentive in order to exercise early, which we'll get into later. But when you're short an American-style option, you can be assigned at any time up until expiration. All right, so the covered call. So as I mentioned before, usually this is the first options trade that many people get involved with because they already start with a portfolio of stocks. They're sitting, they have a bunch of stocks they're sitting on, and maybe they're looking to create a little income against those shares. So they might consider selling calls against their shares. So remember that every option is the right to buy or sell 100 shares of stock. So if I own 100 shares of stock and I sell one call against it, I'm covered. Okay, I have the shares to deliver against my short call in case somebody decides to exercise. So there's two types of covered calls. There's a buy right. The first one, let's just say I don't have a position at all, and I buy 100 shares and I sell a call against it, either an at the money or an out of the money call against it. That's called a buy right. If I actually already own the stocks themselves, and I then sell calls against my existing holdings, that is known as a covered call. So once again, a buy right and a covered call, it's the same thing. It's just one. The first one is you buy the stock and sell the call at the same time. The second involves basically already being long stock and then selling calls against it. So the primary goal in this strategy is to increase returns, and we're looking to generate a little bit of income on our long stock holdings. So, and this is over and above any short-term capital appreciation on the shares, plus any dividends that might be collected. So, and this is really important. So anybody who's looking to put on a covered call is doing so from the mindset that they are neutral to moderately bullish on their underlying stock, okay? So, and this is very important, because if you were very bullish on your shares, you wouldn't sell covered calls to begin with, because by selling calls, you're essentially tapping your upside profit potential on those shares, okay? And if you were very bearish on your stocks, you wouldn't sell covered calls, because while, yes, the covered call does afford you a certain amount of protection to the downside, that protection is limited by the amount of premium that you take in. So, on a big downside move, your risk in a covered call position is really in the long stock position. So this really only fits somebody who's kind of neutral to moderately bullish. You think the stock is just going to kind of trade in a quiet little range over the next month or two, or you think it's just going to kind of stair step up gradually, but it's not going to make a big move either way. That might be an instance when you might consider a covered call. So kind of building on what Dave said in the first presentation, as call buyers have rights, sellers have obligations. So when we sell calls against our long holdings, we are obligated to sell those shares at our strike price should we get assigned. So if somebody decides to exercise and we get assigned, we would have to deliver 100 shares per contract that we're short. And this can happen at any time on or before expiration when we're dealing with American-style options. And in return for this obligation, that from selling the calls, we receive option premium, and that's ours to keep regardless of what happens. So what's the profit and loss scenario? So the upside profit potential on a covered call is going to be limited at the short strike that we sell. So the formula basically is it's our strike price minus the price that we pay for our stock plus the premium that we received on that call. When you do all the math, that's the maximum profit potential we can make on a covered call position if we are assigned at our short strike. Now, our break-even point is going to be our stock price minus the call premium received. So let's just say I bought stock for $50 and I sold a 55 level call against it for, say, $2. Now, since that $2 is really $200, because remember, every contract is the right to buy or sell 100 shares of stock, that $2 is going to offset my break-even price on the stock. So I bought stock for $50, and by selling that $2 call, it's going to reduce my break-even from $50 down to $48. So my new break-even, if that call expires worthless, would be similar to being long shares from $48. Now, the downside, once again, in a covered call position is always in the long stock position, because below our new break-even price, in this case 48, we would lose 1 for 1 on our shares to the downside all the way to 0. So, the risk is really in that long stock position. So the option premium helps us to a degree, but it's very limited in terms of protection. All right, so let's look at an example. Let's say we own shares from 52, and we're neutral to moderately bullish over the next month, and we're looking to generate some additional income, and we have a target sale price for the stock. So even if we got assigned on this stock, we'd be happy to have it called away at $55. So we go out our options chain and we see that we can sell the 1 month out 55 level call for $1.75. So that $1.75 is ours to keep. And remember, it's 175 because for standard options, the multiplier is 100. So we would get to keep that 175. Now let's look at the P&L for the position come expiration. Now, the reason why we look at P&L at expiration is because it's a clean way to look at the P&L, because at expiration, that option doesn't have any time premium left in it. So it's really a clean way to look at the actual P&L. So let's just say we put on this position, we bought stock at 52, we sell the 55 level calls a month out for 175, and let's just say the stock goes nowhere, and it's expiration. Well, if the stock finishes at 52, you can see that we make nothing on our stock. We're just zero P&L. But on the flip side, we make 175 on the call we sold, because with the stock trading 52, the 55 level call in theory has no value. So we would keep that 175. That would be our profit. Now that would represent a return of 3.4% over a month, and if you amortize that over 12 months, that ends up being just over 40%. But that's if you could do it at the same price over and over again every month. But just goes to show you for a 1 month's return, it's not too bad. Now, what if the stock goes to 55? Okay, if the stock goes to 55, right at our strike, we would, and remember this is an expiration, we would make $3 on our stock. We would still keep the 175 from the call we sold, because in theory, this 55 level call with the stock finishing at 55 would really have no value. It would go out worthless in theory. We would keep $4.75. So, and as you can see, that's the maximum profit potential on this position. If the stock goes to 60, we're still only going to make $4.75. If the stock goes to 100, while that's unfortunate, we're still going to make $4.75. We would just forego the opportunity cost of participating on any gains above 55. But remember, we only did so because we were neutral to moderately bullish on our shares to begin with. So now let's look on the downside. Remember, our break even is going to be the price that we paid for the stock minus the premium that we took in, 175. So 52 minus 175 gets us to 50 and a quarter. So with the stock at 50 and a quarter, we would be down 175 on our stock holdings, but we would make 175 from the covered call for a net P&L of 0. And then, as you can see, if the stock goes south at 45, we would lose $7 on our stock. We would lose 175. We would make 175 on our call for a net loss of 525. So, as you can see, below 50 and a quarter, we lose 1-for-1 on our shares all the way down to 0. So once again, just exemplifying that idea that the risk in any covered call position is in the long stock position below the new break-even spot. Okay, here is that same example in graph form. So sometimes sometimes it's easier to see this visually. Some people are more visually oriented. So here we have in the green dotted lines just being long stock at 52, pretty straightforward. If stock's above 52, we make money. If stock's below 52, we lose money. By selling this 55 level call against our stock at 52, the blue line, this is our covered call P&L. And as you can see, below 50 and a quarter, that's our break even, but below that we have losses 1-for-1 on our shares. The covered call doesn't help us any longer. And on the upside, we are capping our gains at the short strike, the 55 level. And as you can see, the maximum profit is $4.75. In other words, the strike price plus the premium that we receive minus what we paid for the stock gives us our maximum profit potential. And once again, the break even is what we paid for the stock, 52, minus the premium we took in, 175, gets us to 50 and a quarter. All right, so now let's look at a different position. So now we have our stock that's trading for $59. And maybe we have a little further, we think the stock's going to be really quiet over the next 2 months. So we look at our options chain and we see that we can sell the 65 level calls, and they're trading for 2.25. And once again, we're doing so because we are neutral to moderately bullish, and we're just looking to generate some income. So anytime you put on a covered call, it's almost like you're kind of creating a synthetic dividend stream. While it's not a dividend, that's essentially what you're doing. You're creating this income stream, and hopefully that call expires worthless, and you can do it over and over and over again. And every time you do it, it lowers that break-even price on your shares. So we buy the stock for 59. We sell the 2-month out June 65 call for 2.25. Let's fast forward to expiration 2 months. At expiration, if the stock's rated 59, we don't make or lose money on our shares. We would keep 225 from the sale of the call for a total P&L of 225. That 225 also represents about a 3.8% return over 2 months, and you amortize that over a year, that's about a 23% return. Now, if the stock goes up to 65, we would make $600 on our long stock. In theory, the 65 level call goes out worthless. We would keep the 225 for a total P&L of 825. But as you can see, above 65, that's the most we can make on this covered call position. Now, our break even, once again, is going to be the stock price we paid, 59, minus the premium that we took in, 2.25. So when we do the math, that gets us to 56.75. So at 56.75, we would neither make money nor lose money at expiration. We're just breaking even. But as you can see, below 56.75, we lose 1 for 1 on our long stock holdings. If the stock goes to 50, we lose 900 on our stock. We still make 2.25 from the sale of the call for a total loss of 675. But as you can see, the risk really is in that long stock position. Now, also keep in mind that if the stock goes to, like, say, 65 at expiration, and in theory, this call is going to expire worthless, now you're pinned at your strike. This is called pin risk. So many traders, to avoid an unwanted assignment, would buy back this short 65 level call, maybe for a few pennies, maybe for a nickel or something, and reevaluate the position. Maybe sell a 70 call or 75 level call against it. It creates even more income. But just because, even if the stock closes at, say, 64.50, okay, and you're short this call and you're saying, well, it's a 65 call, it's out of the money, it's worthless. Just know that, news does come out in the aftermarket. So just because you're short that call at expiration and it appears to go out worthless doesn't mean you still can't be assigned on that call. So to mitigate an unwanted assignment, people who get pinned right at their strike prices will typically, most traders would choose to basically buy back their short options. Once you buy back any short option, you mitigate and you have no assignment risk whatsoever once you buy back those short contracts. But, everybody's individual. It's up to you what you want to do from a forecast and a risk perspective. All right, so here's that, once again, that position in a graph form. So as you can see, our break-even's at 56.75. The maximum profit potential is at 65, which is 8.25. Our strike price, our short strike price, plus the premium that we took in, minus the price that we paid on our stock, it's 8.25. And our break-even, the price we paid on our stock, 59, minus 2.25 that we received, gets us to a break-even of 56.75. But below 56.75, we have 1 for 1 risk on our long stock position. Okay, so now something to keep in mind. Let's just say we're long stock from 59 and we are short the 65 level calls. And now stock is trading 75 at expiration. So if we do nothing, okay, we're surely to get assigned on this call because it's $10 in the money. So we would have to evaluate. We would either have to, one, buy back that short call to close and stay long the stock if we didn't want to get assigned and lose our shares, or maybe buy back that 65 level call, hopefully close to its intrinsic value, and maybe sell a higher strike call against it. Maybe if the stock's at 75, maybe sell the 80 calls or the 85 calls against it to create some more income and generate some more upside on the shares. So once again, it's going to be completely up to you. Now, remember what I mentioned earlier when we talked about early exercise with American-style options. Anybody who exercises an option early, typically there has to be an economic incentive to exercise early. And the biggest reason why somebody might exercise an option early, or at least a call option early, is for a dividend. And this is going to be really important if you're somebody who's going to consider doing covered calls on stocks that pay particularly large dividends. So let's just say, using the same example, we're long stock from 59, we're short 65 level call, stock's trading 75. So that call is, and let's just say there's a week to go to expiration. So that call is going to be $10 in the money, has $10 of intrinsic value, and maybe it's trading for $10.10. So it has $10 of intrinsic value and 10 cents of time premium, or extrinsic value. And let's just say tomorrow, with a week to go to expiration, tomorrow the stock's going to go ex-dividend for 50 cents. In other words, the company's going to pay a 50-cent dividend. If the dividend is larger than the premium, the time premium in that option, in this case, the 50-cent dividend is larger than the 10 cents of time premium in that option is a strong candidate to be exercised early for the dividend. In other words, somebody might choose to exercise that option early, forego the remaining 10 cents of time premium in the option in order to capture the 50-cent dividend. So if you find yourself in one of these situations right before a stock is about to go ex-dividend and there's not much time premium in the option that you sold, you're going to want to mitigate and do some risk management here, either buy back that short option outright in the market and just stay long the stock, or roll it to a higher strike where you won't get assigned. So once again, you want to discuss with your broker before taking action. But we get calls from investors all the time saying, I had this covered call on, stock went ex-dividend, and I woke up, the next morning with a bunch of cash in my account. What happened? Well, what happened was this call was deep enough in the money. Somebody who was long it exercised for the dividend. You got assigned. Yeah, you made the maximum you possibly could on that covered call position, but you didn't get the dividend and you lost your stock. So, once again, if you're ever in a situation like that, once again, have a discussion with your broker, but you'll want to know that formula, that if the dividend is larger than the time premium left in the option, you'll want to take some measures to manage that position. Okay, so that is covered calls. So now we're going to look at a variation of the covered call, and this is known as the poor man's covered call. But before we talk about the poor man's covered call, we're going to talk about leaps, because leaps in this instance are going to be used as a stock substitute or replacement for stock. So what exactly are leaps? Well, leaps, they were introduced in 1990, and they're essentially just longer dated options. They're options that are anywhere from 9 months to 2.5 years out. And LEAPS stands for long-term equity anticipation securities. I know that's a mouthful, but basically all they really are just longer dated options, okay? And right now we have January 2024 LEAPS, 2025 LEAPS. Those are over 600 days away. And typically they list the new LEAPS in the third quarter. Typically it's in September. This year they'll be adding the 2026 LEAPS will be added to stocks on September 11th. So if you ever want to know when the LEAPS will be added, you can always go to our website, download an expiration calendar and go to September. It'll tell you when those LEAPS will be listed. But also keep in mind that LEAPS aren't available on all securities, okay? They're, it's a smaller pool. It's usually the LEAPS are listed on stocks that more popular issues, the more liquid issues, the ones that trade more frequently. So the exchanges ultimately decide which options they decide to list LEAPS on. So it's not available on every product. Now, some of the benefits of LEAPS are it allows investors to use less capital than purchasing the shares up front. So, alluding to the earlier to Dave's talk about options and leverage. So the beauty of options is options create leverage. So you can buy that call option for less money, you can buy an option that is the right to buy 100 shares of stock for considerably less than the stock itself. So this is why people love trading options, because of the leverage. So somebody who's looking to use a leap as a stock substitute will typically do so using a leap that has a very high delta. In other words, it's a delta that is going to be close to 1, or the value of, moves in a similar fashion to the stock. So a stock itself has, we would say, has a delta of 1. So if you buy 100 shares of stock goes up by $1, you make $100, and if the stock goes down by $1, you lose $100. So stock has, even though stock doesn't have Greeks, the stock itself would be considered as a delta of 1. So if you buy an option with 100 delta, that option is going to move 1 for 1 with the stock both up and down. So people who use leaps as a stock substitute will somewhat target leaps anywhere from about 80 to 100 delta, depending on their risk tolerance as a stock substitute, in order to allow them to use less capital than purchasing the shares outright. Okay, so the pricing that goes into leaps. The pricing that goes into leaps is the same pricing for regular options. So these are all the components that go into an options price. So if you have an options calculator, it's gonna take the options price, the strike price, the time to expiration, the implied volatility, dividends, and interest rates. When you put all that into an options calculator, it's going to spit out a theoretical value. It's no different than leaps. It's just that leaps have longer time to expiration. So the inputs that go into a leap are going to have a different impact on the price of the leap, which we'll show in the next few slides. So Theta, as Dave mentioned in his presentation, is your option Greek that measures how much your option loses value every single day. So remember that an option has a finite life. So every day we get closer to expiration, in theory, that option is worth less and less and less. So people who are long options experience negative theta. In other words, they pay theta. And people who are short options experience positive theta, or they're collecting theta. So we always say that theta is a foe to option buyers and a friend to option sellers. So, you have that force of time decay that's working against you if you're long options, and it's working for you if you're short options. Now, time decay, or theta, doesn't decay in a linear fashion. So leaps, as you can see, that are far out, so if we have a 365 days to go to expiration, you can see that this at-the-money option has a theta of about half a cent. Okay, so in theory, if the stock just sits there and all other factors remaining constant, stock doesn't move, in theory, it should lose about half a cent a day. But as you can see, as you get closer and closer to expiration, the slope of this line gets steeper and steeper, and that's because options don't decay in a linear fashion, they decay in an exponential fashion. So as we get closer and closer to expiration, you can see that those options decay quicker and quicker. And this is why people who like to sell options typically target options that are anywhere from about 30 to 40 days out, because it's those options that really that's about the sweet spot where options really start to decay a lot faster, okay, than their longer dated counterparts. So once again, you can see that slope of that line getting steeper and steeper the closer and closer we get to expiration. Now, the big thing about leaps is because when we buy leaps, okay, those options, the longer dated options, they're going to have more time priced into them. And because they have more time priced into them, they have more time premium. And leaps are going to be a lot more sensitive to changes in implied volatility, which is measured by the Greek vega. So vega is your option sensitivity to changes in implied volatility. So it's always going to be greater for the longer dated options because those options comprise more time premium. So if we are long-term options, some leaps, and implied volatility goes up, well, that's going to benefit us because that's going to increase the extrinsic value or time premium in our option, and our option is going to be worth more than what we paid for it. Consequently, if implied volatility goes down or gets crushed for whatever reason, we're going to lose money because those options are more sensitive to changes in implied volatility, and a decrease in implied volatility is going to negatively impact our long leap positions. Okay, so all that being said, now let's look at using leaps as a stock replacement. People will use leaps sometimes as a stock replacement as an alternative to stock ownership because it allows you to benefit from rising stock prices while risking less capital to do so. Now, when you own a leap, just like owning any option, you own the right to exercise that contract on or before expiration for whatever reason they take delivery of the shares. Now, nobody who in their right mind who owns a leap is going to exercise it early because they would be foregoing any time premium. But just know that you when you own that option, you still own the right to exercise it at any time you wish. But you're using it as a stock replacement, so it's the leverage you want. You don't necessarily want the stock; you're using it as a stock replacement. So some of the risks of leaps are the premiums will typically be higher than the near-term options. That's intuitive because with longer time in the option, those options are going to be more expensive. Your risk in any long option strategy is the amount of premium that you pay for that option. Stocks are a long-term investment. Options do expire. They have a finite life. Even leaps at some point will expire. Okay, so they are subject to theta and time decay. They're also more sensitive to changes in implied volatility, and leaps may require position management. If all of a sudden your forecast or motivation changes, you may have to reevaluate and look at if you really want to be in that position. Another thing to think about is the bid-ask spread for leaps tends to be wider for longer-term options. So that might impact your slippage costs in terms of execution. So you want to be really careful if you're trading leaps to use limit orders, and once again, talk to your broker at E-Trade if you're looking to do this. But the last thing you want to do as an investor is cross a very wide bid-ask spread, whether you're buying an option or selling it. So with those wider bid-ask spreads, certainly use limit orders when trying to execute your strategies. And lastly, the biggest difference for leaps is they don't receive dividends. Okay, only stockholders receive dividends. Option holders don't, unless of course an option holder decides to exercise their call and take delivery of shares. Now you're a stockholder, but anybody who owns a leap wouldn't do so because once again they would be foregoing any time premium of that option to take delivery early. So the primary reason we're buying that leap is really to as a stock substitute, not necessarily we're doing it in this case for the dividend. All right, so now let's look at the poor man's covered call as an alternative to the covered call. So a poor man's covered call is a capital-efficient way to simulate a standard covered call. And it consists of buying a longer-dated, high-delta option and selling a near-dated, out-of-the-money option against it. So essentially, it is a diagonal spread using an option, the leap, as a stock substitute in order to put on a position that's similar to a covered call but with a lot less capital. So let's look at the two side by side. So here we have the traditional covered call and the poor man's covered call. So the market bias is the same. We're going to do this if we're neutral to moderately bullish on both positions. Our upfront capital is going to be substantial with the covered call because it's going to take a lot more capital to buy the stock. The capital is going to be substantially reduced with the poor man's covered call. Our upside profit potential is going to be limited in both cases. The downside risk is always going to be more substantial with the long stock position, so the covered call is going to have substantial risk. The downside risk with the poor man's covered call is going to be substantial, but it's going to be less because we're paying less for that position. Assignment risk is always a possibility with the covered call with American-style options. Now, with the poor man's covered call, it's possible that if we get assigned on our short call, we might be long the leap and short stock for one day. So once again, if your short call is in the money and you're approaching expiration with the poor man's covered call, you're going to want to take some risk measures and possibly buy back that short call or roll it to a higher strike to mitigate an unwanted assignment. But just know that it is possible if you get assigned on your short call with the poor man's covered call, you might be short stock for one day. So once again, you'll want to discuss this with your broker if you're in that type of situation. Your break-even point on the covered call, once again, is the stock price you paid less the call premium that you received. The break-even for the poor man's covered call is going to be the long strike on the leap plus the net debit. Because remember, that longer-term option that you buy is going to cost you more than the near-term call you sell against it. You're going to be putting that position on for a net debit. So that debit gets added to the call strike. That's going to be your break-even for the poor man's covered call. And once again, the biggest risk in leaps is the Vega exposure. Long stock has no Vega exposure. The leaps have greater exposure to changes in implied volatility just because of the more of the time premium that is in those longer dated options. So once again, somebody that's going to put on the poor man's covered call is going to do so looking for a deep in the money call to buy for leverage, and with a delta that's anywhere from 80 to 100. So you'll mimic the moves as close to the stock as possible, and you're going to look to sell near-term calls against it. So let's look at an example. Here we have a stock trading for 82, and we see on our options chain that we can buy the Jan 2024 70 level call, which has an 83 delta for 14 and a quarter. And we can also sell the May 85 calls, the near-term calls, for $2. Now, you can see the bid-ask spread is really wide on the Jan 2024 calls, which you would naturally expect to see with leap. So once again, in this example, we're buying the offer and we're selling the bid on the Mays, but if you're really going to do this, I really strongly suggest that you use limit orders to execute this in order to control your costs and the slippage costs. So once again, you'll want to talk to your broker. But just for this example, let's just assume we're going to put this position on. We're going to buy these calls for 14 and a quarter. We're going to sell the near dated ones, the 85 level calls, for $2. So we can either put on the traditional covered call, buy stock at 82 for an outlay of $8,200, or we could buy the January 2024 call, the 70 level call, for 14 and a quarter. Once again, we're not going to be entitled to dividends with the call, and the bid-ask spread may affect our break-even point. And in each situation, whether it's the covered call or the poor man's covered call, we're going to still sell the May 85 call for $2. And ideally, we'd like to repeat this throughout the life of the long call that we own, the leap call, because every time these calls that we sell goes out worthless, we lower the break-even cost or the overall cost for this longer dated January 2024 70 level call. All right, so the traditional call versus the poor man's covered call. As you can see, the traditional covered call is going to require an outlay of $8,000. Long stock at 82, 100 shares, it's 8,200, less the short strike, the short 85 level calls that we sold. That's a total net investment risk of $8,000. The poor man's covered call, on the other hand, is going to only cost us $1,225. Okay, we paid 14 and a quarter for the long call. The short call, we received $2. So as you can see, there's a considerable difference in the overall outlay between the two strategies. And this is why people like the poor man's covered call, because it is the leverage that options provide. So now let's fast forward to expiration and examine these two positions together. So let's just say we'll fast forward to the May expiration, and we put this position on because we are neutral to moderately bullish, but unfortunately the stock didn't go our way. It went actually south. Well, with the standard covered call, we would lose $5 on this position. We would lose $7 on our stock. We would keep the $2 premium from the 85 calls we sold for a total loss of $5 or 6%. Okay, so we would be down 6% on this position. Now, with the poor man's covered call, we would lose $5.60 on our leap. We would still make the $2 on our May 85 calls for a total loss of $3.60, which would be a total loss on the position of 29%, because remember that leap decreased by $5.60, which is consistent with a higher delta. So it's that idea that Dave alluded to earlier in his first presentation about leverage. So people use options because of the leverage involved. So leverage is a double-edged sword. You know, leverage is great when it's going your way, and it's really bad when it's going against you. In this case, if we put on the poor man's covered call, we would be down 29% in this scenario. But remember, we paid considerably less for the position as well. So just to point out those two positions side by side. Now let's fast forward and say, okay, well, what if at May expiration, XYZ is trading for 90? Okay, well, at 90, the poor man's covered call is going to be up. I'm sorry, the actual covered call is going to be up $5. So that's going to be a return of 6%. We're going to make $8 on our stock. Our short May 85 call now is in the money by $5. But remember, we took in $2 when we sold it. So that's going to be a net loss of $3 for a total gain of $5 or 6% return. Now, the poor man's covered call, the call is going to gain $6.40 in value. We're still going to be down $3 on the May 85 call that we sold for a total P&L of $3.40. But once again, this is going to be now leverage is going our way, and we're going to be up 28% on this position. So you can see that even though the stock went up, we made more on a percentage basis with the poor man's covered call than we did on the traditional covered call. But once again, that idea that leverage is a double-edged sword, and when it's great, it's going with you, it's fantastic. But when it's going against you, it's not so great. Okay, so in concluding here, the benefits of the poor man's covered call are, one, less capital that you have to allocate. It's going to be a higher return on investment should your thesis work out. There's going to be less margin required, less capital at risk, and theta is always going to be smaller for the leaps than they would be for the shorter dated options. So time decay isn't going to be such a factor when you own those longer term leaps. Now the drawbacks are going to be that you don't participate in any dividends owning the leap as you would with the stock. Fewer stocks have leaps, and once again you're going to have a smaller universe from which to trade these products. But there are a considerable amount of products that do have leaps, so you'll want to check with your broker and see which products have leaps. And the implied volatility is probably the biggest factor when it comes to leaps because of the added amount of time in them. So implied volatility, if it goes up, it's going to positively impact your leap position. If implied volatility goes down, it's going to negatively impact your leap position. And lastly, if you trade leaps, once again, you're probably going to be experiencing wider bid-ask spreads. So please, I implore everybody to use limit orders when doing so. Talk to your broker. But those wider bid-ask spreads can really impact your overall P&L. So certainly use limit orders when executing these strategies. All right. So once again, here's a little polling question to gauge your interest in the strategy and how confident you are with the strategy before and after you attended. So that really is the end of my presentation. And I know we have a little bit of time. I don't want to cut into Rick's presentation on puts, but let me bring on Rick, and maybe we can do a little live Q&A for a few minutes to finish up here. Can you hear me, Rick?
Hey, I got a feeling Rick is not on the call. Ken, it's Dave.
Oh, okay.
But let me, yeah, I'm looking through the thing, and I don't see Rick there. Maybe he's in the audience. Let me just speak to sort of some general things that came up. A lot of questions were about stuff that we specifically covered in our opening topic. And some of the dialogue here was like, is there a sequence here? There very much is. Each session builds upon the other. So remember, if you go to etrade.com/bootcamp, you can get all of these sessions. The recording will be up, 45 minutes or so after we finish each one. I know the opening one is up there now. You can also get a copy of the slides by going to the on-demand recording of that. The other thing is, a lot of the questions were, how do I do this thing on the platform? And that's why we have 2 specific sessions at the end of the day where Sean and I are going to focus specifically on those various steps. So it's hard to get it all at one time, but we are building through that. So I hope you'll at least stick with us or make sure to come back and watch our various recordings. The last thing I'll say is a lot of discussions about price targets. How do I figure out where a price might go and the strike price? And for that, it's separate from this topic. I'll just say learn chart analysis, learn technical analysis. It's a big part of it, and it's something that we also teach in our etrade.com/events recorded webinar sessions. So with that, we are going to move to the next topic. We got 9 minutes, and we are going to be turning the mic over to Rick Swope for the power of the put. Ken, thank you so much. Great job. Really good stuff from OIC. I got a lot of favorable comments in here as well. I think people are really enjoying the day. I hope they can keep their attention span with us. Take care, folks. We'll talk to you next time around. Bye-bye.
Thanks. Thank you.